The pitch is everywhere, and the promise sounds undeniable and familiar. Financial advisors, forum threads, and flashy videos all tell you to buy REITs, because real estate supposedly makes portfolios safer and richer. That message feels right in a world where owning some piece of the physical economy sounds like owning a bit of the future. Before you obey that advice, you have to know what a REIT actually is and how it behaves differently from houses or rental apartments. Real estate investment trusts, or REITs, are companies that own and often operate income-producing properties, and they distribute most taxable income to shareholders. Knowing they are corporations listed and traded on exchanges matters, because liquidity, valuation, and regulatory rules shape their returns very differently from direct real estate ownership. REITs have specific legal requirements that make them unique and influential in portfolios, and those rules are worth understanding. To qualify as a REIT, a company must distribute at least 90% of its taxable income as dividends and must meet asset and income distribution tests under law. Those legal constraints explain why REITs pay high dividends, but they also explain why they often retain less capital for reinvestment than other corporations. Not all REITs are made equal, and the categories matter in ways that influence risk and return. Equity REITs own and operate properties like apartments, malls, warehouses, and hospitals, while mortgage REITs invest in loans and mortgages, creating different exposures to property cash flows and interest rates. Hybrid REITs mix both strategies and can be more complex and harder to model. So understanding type matters before committing money. Liquidity and accessibility are part of the REIT argument, and those benefits feel convincing on the surface as well. Public REITs trade on exchanges and let small investors buy fractional ownership of large commercial properties without management hassles or seven-figure capital requirements. That liquidity also creates price volatility that depends on market sentiment and macro conditions rather than the slow-moving fundamentals of physical property. One strong reason to consider REITs is for dependable income when dividends are reliable and backed by cash flows. Many investors use REITs inside tax-advantaged accounts to shield ordinary income from immediate taxation, making the after-tax yield more attractive. Using REITs for income becomes especially compelling for investors who need regular distributions and cannot or do not want to manage physical properties themselves. Diversification is another argument often made for REITs exposure, and the logic holds when done correctly over a well-rounded portfolio. REITs can provide exposure to property sectors that are hard to access directly, such as large logistics portfolios, data centers, or specialized medical facilities. But diversification only works when you consciously choose varied REIT types and geographies, rather than buying a single name or sector and calling it a day. You must also confront how interest rates shape REIT performance, because REITs often move with yields in surprising ways. When bond yields rise, REIT dividend yields can look less attractive relative to safer alternatives, pressuring share prices even if property cash flows remain stable. That sensitivity makes timing and context important, but it does not automatically disqualify REITs as a component of long-term portfolios. Risks in REIT investing are real and should guide the size and timing of your allocation in patient ways. Leverage in REIT balance sheets amplifies returns on the upside and losses on the downside, and high leverage can crystallize problems quickly when rents decline or refinancing becomes expensive. Operational risks like vacancy, tenant default, and obsolescence also matter and require deeper sector knowledge than the word real estate alone might suggest. Management quality is a subtle risk that many investors underestimate when they buy REIT shares blindly. Boards and management teams make critical decisions about acquisitions, dispositions, and capital allocation that materially influence long-term returns and shareholder outcomes. Evaluating management means reading more than glossy presentations. It means digging into transaction history, executive incentives, and alignment with long-term shareholders. If you want to evaluate your REIT exposure sensibly, start by measuring cash flow quality, rather than headline dividends alone. Funds from operations, or FFO, and adjusted funds from operations, AAAF, provide cleaner pictures of the cash REITs generate for distributions than GAAP earnings often show. Price-to-FFO and payout ratios relative to FFO, or AFO are for comparables across names, and help reveal sustainability or stress before dividends are cut. Balance sheet health is the next piece of the puzzle, and often the difference between survival and crisis during downturns. Pay attention to loan maturities, interest coverage, and debt to asset ratios because refinancing risk can cascade into forced asset sales. Liquidity buffers and conservative covenant structures mean a REIT can weather turbulence, while thin liquidity makes even high-quality portfolios vulnerable to shocks. Sector concentration is a practical risk most casual investors overlook until it is too late and portfolios underperform. Investing only in retail REITs in an e-commerce age, or only in office REITs, amid structural shifts to remote work can create painful losses. A better approach requires assessing secular trends and balancing exposures to sectors that are growing, stable, or cyclical. Let me give you concrete examples, because strategy becomes clearer with specific names and outcomes that you can study. Prologis is an industrial REIT that benefited immensely from the explosive growth of e-commerce by owning strategically located logistics facilities worldwide. Conversely, a mall REIT that was heavily concentrated in underperforming retail tenants provides a cautionary example of sector risk and the need for adaptive management. Realty Income, known as the monthly dividend company, shows how consistent cash flow and conservative acquisition strategies can create a long-term income story. Realty Income focuses on single-tenant retail properties, with long-term leases, creating predictable rent streams and a durable distribution track record. Investors should study that business model for lessons about lease structures and tenant quality, rather than assuming dividend automatically means safety. Data center and cell tower REITs represent a modern frontier in property ownership that many traditional investors miss. These companies own infrastructure that underpins the digital economy and sometimes enjoy structural demand that outpaces general commercial real estate trends. Allocating a portion of your REIT exposure to these specialized sectors can provide growth properties within a dividend framework, but valuation discipline matters greatly. Now consider mortgage REITs, because they operate on a completely different risk axis that deserves caution and respect. Mortgage REITs earn profit from the spread between borrowing costs and mortgage yields, and often use significant leverage to amplify small spreads into large returns. That leverage makes them extremely sensitive to rapid interest rate swings and credit events, which historically produced dramatic dividend cuts and share price collapses in stressed environments. If you decide REITs belong in your strategy, you must consider where they fit relative to direct property ownership and private real estate funds. REITs offer liquidity, lower minimums, and passive management, while direct ownership gives you control, potential tax advantages, and localized cash flow dynamics. Private funds and syndications can bridge those worlds by providing active management and access to deals, but usually require higher minimums and longer time commitments. Practical allocation rules matter more than slogans, so think about size, time horizon, and purpose before committing capital to REITs. Use a smaller allocation for speculative sector plays and a larger allocation for income needs that require liquidity and diversification across property types. Younger investors seeking long-term growth may prefer industrial and data center exposure, while retirees might prioritize diversified income REITs within a tax-efficient wrapper. Tax treatment is a practical detail that changes the after-tax value of REIT income and should influence where you hold them, because REIT dividends are often taxed as ordinary income. Holding them in tax-advantaged accounts like IRAs or 401(k) usually preserves more of the yield. Understanding qualified business income rules, state-level implications, and how return of capital works in specific funds prevents nasty surprises at tax time. If you prefer a passive route, REIT ETFs and mutual funds can simplify diversification and reduce idiosyncratic risk from single names. ETFs track baskets of REITs and offer instant exposure to sectors or the entire REIT market with low costs and easy rebalancing. However, ETFs also inherit sector-level bubbles and correlation spikes. So even broad REIT ETFs require periodic reassessment against your portfolio goals. For investors who can tolerate more complexity and less liquidity, private real estate funds and direct syndications provide concentrated exposure with active management. These vehicles can access value at deals, renovation, upside, or geographical arbitrage that publicly traded REITs cannot easily replicate. The trade-off is capital lockup, higher fees, and the need for careful due diligence on sponsors and projected returns. Crowdfunding platforms have lowered the barrier to private real estate deals, but introduced new diligence requirements and platform risk. They allow smaller investors to participate in specific projects, sometimes with equity, like upside or fixed income, like cash flows depending on the deal structure. That accessibility is attractive, but platform vetting, sponsor track record, and exit strategy clarity are essential before investing small amounts across many speculative projects. There are times when avoiding REITs is the rational decision, and other times when avoiding direct ownership makes sense instead. If you expect rising interest rates combined with slowing rent growth, overweighting REITs in an income portfolio increases vulnerability to multiple compression. Alternatively, if you already have significant private real estate exposure through rental properties or private funds, public REIT purchases might create unintended concentration and correlation in your overall portfolio. Avoid speculative mortgage REITs if you cannot tolerate rapid dividend, volatility, and balance sheet risk in stressed markets. Those vehicles can offer enticing yields during calm times, but historically have been first to cut distributions during credit stress. If your financial plan depends on steady cash flow, prefer equity REITs with transparent balance sheets, or hold REITs inside tax, deferred accounts to preserve after-tax income. Timing the market rarely works predictably, but timing your exposure relative to asset allocation and rebalancing rules can improve outcomes. Use rebalancing to sell REIT gains into other assets when valuations spike and consider dollar cost averaging to reduce entry timing risk. These practical portfolio mechanics make REITs behave more like a disciplined strategic allocation rather than a speculative trade. A clear decision framework helps you choose among REITs, direct property, and private funds with less emotion and more math. Start by identifying your primary investment goal, whether that is income, growth, diversification, or tax efficiency, and match vehicles to those objectives specifically. Then apply filters like yield sustainability, balance sheet strength, sector outlook, and management quality to narrow choices to reasonable candidates. Constructing a practical example allocation makes this abstract guidance tangible and actionable for many viewers. A moderate investor might allocate 5 to 15% of a diversified portfolio to REITs, with half in a broad REIT ETF and half in sector leaders like industrial or data center REITs. That structure provides liquidity, income, and targeted growth exposure without doubling down on any single risk factor. For conservative retirees, a different example shows the trade-offs more clearly and points to practical adjustments. Holding REITs inside tax, deferred accounts, and favoring diversified income REITs with long lease terms and low leverage can stabilize distributions. Additionally, keeping a smaller direct property allocation, or liquid cash buffer, reduces the chance that you must sell illiquid assets at inopportune times. International REITs add geographic diversification that reduces single country property cycle exposure and opens access to different growth dynamics. Markets like Europe, Asia, and Australia host listed real estate sectors that behave differently from American REITs and can provide non-correlated returns. Currency risk and different regulatory environments matter, so international exposure should be intentional and not accidental. If you are building a long-term plan, measure success in outcomes instead of comparing yourself to investment dogma about REITs. Does your portfolio achieve the income, growth, and risk profile your life goals require, and does it allow you to sleep at night during turbulence? If REITs help achieve those outcomes more efficiently than alternatives, they belong in the plan. And if they do not, you can deliberately exclude them without guilt. In investing as in life, understanding nuance matters more than following slogans and popular advice blindly. REITs are powerful tools for certain goals and dangerous mistakes for careless investors. And the right answer depends on context, not tribal rules. Educating yourself about structures like FFO, balance sheets, sector dynamics, and tax wrappers transforms REITs from a reflexive recommendation into a precise instrument in your financial toolkit. If this video gave you a clearer framework for deciding about REITs, your next step is small and powerful and involves real research. Pick one REIT or one REIT ETF and spend an evening studying its most recent earnings report, capital structure, and tenant list to ground your understanding. That practice will reveal more about real estate investing than any slogan ever will, and make your allocation choices more intentional. Ultimately, the philosophical twist is simple but important. Real estate exposure is not a single thing but a spectrum of assets, risks, and strategies. Whether you choose REITs, direct ownership, or private funds, the critical question is how well your choices align with your time horizon, liquidity needs, and understanding of underlying economics. Treat REITs as one tool among many and decide, based on evidence, not pressure, and your long-term financial life will thank you. If this gave you a new perspective, hit subscribe and join a community that values thoughtful investing over simple slogans. Leave a comment with the REIT or property sector you want to learn more about next, and we will dive deeper into real examples and model them on screen. Thanks for watching, and remember that the best investment decisions are the ones you understand.